Hey, what's going on, man? Welcome to the channel. So this can be the first video, a bit of a welcome video, but at the same time too, this is going to be me essentially laying the foundation for how I look at markets. I'm not claiming to be some expert. I'm not claiming to be something that I'm not. I'm an eternal student of markets. And really, what we're going to be talking about today is um, the machine-like nature behind markets. So yeah, really today's summary is that the markets are not random. Most people would tell you that the markets are in fact random. This is false. I'm not here to prove that to you. However, it is worth knowing that that is a fundamental thesis or a fundamental mental stance or a fundamental understanding at all times that I employ when approaching markets, right? Most people believe that markets are in fact random. We operate the system from a perspective that the markets are in fact not random. They are capital allocation systems that are driven by a price algorithm. Again, I'm not really here to prove that, but this is the framing, this is the perspective that we are working from here. So, really, we are employing this narrative, this thesis in these five asset classes. There are other asset classes that you can operate within. Um, this algorithmic phenomenon, this price engine delivery, this manifests in all markets, right? Not just in these five. For example, right, forex currencies. That's another asset class that we've left out here. But really, what we understand is that capital is essentially moving in and out and in between each of these asset classes, along with other asset classes, constantly at all times. There is a sort of capital allocation algorithm going on interconnectedly or across asset classes, fulfilling the same narrative that also manifests within, a specific asset class and more specifically an asset itself, right? Saying that, say this narrative of the markets not being random also applies to the way that capital rotates in and out and to and through each of these asset classes along with additional asset classes. However, personally, these are the only asset classes that I'm interested in as it relates to this channel. Next, we'll talk about a very basic ICT concept. I'll just take a step aside and address the ICT controversy or whatever that is to you. Maybe that means nothing to you, and I hope that's the case. Look, um, it is simply a system, it is a method of trading. It is not the best method of trading, it is not the worst method of trading. I'm not on here trying to um, say that ICT is a quote unquote no loss system. I've taken plenty of losses trading ICT strategy. I'm not on here purporting that this is a perfect strategy. And I'm also not on here saying that I would do anything different. This is the way that I'm comfortable trading. So saying that to say, man, right? Like any system produces losses. Ultimately, what it's about is the money management. So that's very straightforward, very obvious. Um, but I think worth saying here, with this sort of like open to the channel nonetheless. A lot of people hear that term or hear that, hear ICT and they immediately have this bias or perspective around it. And really, what I've learned, man, is that just because you know ICT concepts or you're familiar with that that language of observation, if you will, um, that doesn't save you from, needing discipline in your account or needing to follow a money management protocol or a risk plan or a max risk exposure defined across multiple time frames, right? You can understand that the market is controlled and still fall prey to human emotion. With all that out of the way, I do believe, though, that the ICT methods are refined and are ultimately a step above uh, traditional indicators or traditional retail trading, simply because it relies solely on time and price, right? That's really all we're looking at as far as our analysis. There are other tools that we bring in, other data points, really, but our primary analysis method is looking at time and price. We're not simply entering because we see it, something that we want to see in time and price. It's overlined with narrative, it's overlined with seasonal patterns and seasonal tendencies, etc. Narratives within the media slash news cycle as well. So all that is sort of like deeper down the line. But we'll actually get into this price engine concept here, right? This is one of the basic ICT concepts, and this is ultimately like the foundation off of the higher time frame as it relates to understanding the flow of capital to and through each of these five asset classes, simultaneously tracking baskets of assets within these asset classes constantly. Using the price engine off of the higher time frame perspective, that is the foundation for my portfolio and ultimately the analysis, whether that is investing or trading. If I'm investing in a higher time frame, well, I would consider anything that I'm holding for 6 months or longer as a quote unquote investment. Anything less than that is a trade ultimately. Um, it doesn't really matter what's going on. I want to always have a perspective or quote unquote be in sync with the higher time frame. And so these are four very basic states of the market. At any given time, the market is ultimately in one of these four states. Simultaneously, any move engineered in the market by the price engine or the quote unquote price algorithm, it starts with consolidation. This is what we are looking for. And ultimately, without consolidation, the market can't go anywhere. Consolidation always leads to expansion. Consolidation can never immediately lead to reversal. It can never immediately lead to retracement. This price engine always starts at consolidation and moves to expansion. From expansion, after having moved from consolidation, the market can either retrace or reverse, right? There could, in theory, be an arrow here going from expansion to reverse. Simultaneously, the way that these arrows just happen to be going clockwise here, this isn't necessarily, that's just how AI drew this diagram, right? I use ChatGPT for this right here. So that being said, right, the market can do other things other than go from consolidation, expansion, expansion, retracement, retracement to reversal back to consolidation. Like other things can occur, and that will be another video, right? But that in and of itself could be a cycle within the price engine. So either way, that first move is consolidation to expansion. After expansion, we could see retracement. We could, in theory, then go back to expansion, potentially to then go back to consolidation. We could consolidate, expand, and then reverse for a while before going back to consolidation. We could consolidate to then expand, to then retrace, to then ultimately see that retracement become a reversal, to then go back to consolidation. We could see consolidation, expansion, retracement, expansion, which we kind of already talked about. So those are just a couple examples, right? A couple flows there, but really just bringing it back to this basic concept. The market always starts in consolidation. We're looking to anticipate expansion, or we are aligning in anticipation in the market and looking to verify that with expansion, right? Either or, sometimes and. After that expansion, we are looking for either a retracement or a reversal. Sometimes price can return back to consolidation. That is possible, right? Consolidation, expansion, consolidation, and then back to expansion, right? Before doing something else. Another ICT concept here, in my opinion, the most effective ICT concept, the market efficiency paradigm. You can understand all of these ICT concepts. If you do not have an awareness of the market efficiency paradigm, you will essentially stay a retail trader. And you could be, quote unquote, technically a retail trader, but be part of smart money. And so, really what's going on here in this diagram is this is a sort of beltway or like a axle shaft, right? This thing is moving, right? Almost like a beltway here, right? So the concept here is that there's these two different groups, and the larger group is the retail, the smaller group is the smart money. So despite being the larger quote unquote drive shaft, right, traditionally in something like this in mechanics, if you will, I'm not too familiar with mechanics, so I won't even pretend to be, but um, the bigger drive shaft is normally the one driving the beltway or the engine or the gears, whatever this is, a small part of, right? The bigger machine itself. In this diagram here, it's actually the opposite. Smart money is actually the one driving the market here. That driving effect, right? This gear and beltway effect is a mental model for the quote unquote siphoning of wealth from retail to smart money. This is a zero sum game. Trading and investing is zero sum. This is simply a visual of that dynamic in a more in depth perspective. And man, I love this. I love the market efficiency paradigm. It's such a good reminder to attune to a certain vibration that is smart money. Simultaneously, it makes you aware of retail behaviors. That could be retail behaviors in yourself, but more importantly, being able to recognize retail behaviors in others and really shield yourself from that. Adopt this mental framing essentially at all times. In kind of a more in depth perspective here, um, retail essentially sees the market as just like this pool of people buying and selling. In their mind, it is the bubble of retail. Most are unaware of another entity being a market participant, essentially. Most do not realize that there is a collective group of traders or a collective. I don't know. Collective is almost, like kind of the wrong word in the way that retail sees themselves as a collective. But, um, anyways, there's another entity in the market that is ultimately taking advantage of retail. However, retail is not fully aware of this entity. Um, there are diametrically opposed behaviors characteristics, beliefs, and skills going on here. Smart money is characterized by poise and professionalism at the end of the day. Retail is essentially just a gambler. Retail is what movies about finance or Wall Street or trading, like retail embodies that. Retail thinks that that's what trading is. They think it is Wolf of Wall Street or Margin Call or Big Short. And those movies are literally about markets and trading, right? But the mental poise found in those movies, um, or lack thereof, these insane characters, these, um, I mean, really just like truly extra personalities. Those were crafted very, very strategically to frame most people's perspective around markets. So, thinking about where else is this done, obviously in the media, newspaper, etc. There is a certain camaraderie that's sold to retail through those medias, right? Feeling like you're one of the smart people. You invest, you must be smart. You know what I mean? Oh, you're watching the financial news, you must be smart. Um, be a good boy and put your money where the TV is telling you to put it, right? We've brought in this expert. He's a really smart guy. Trust us and put your money where he tells you to because he's on TV, right? That whole dynamic is retail. However, if this game is zero sum, why would you do what most people are doing? Why would you consume what most people are consuming? Why would your process even look like how most people have, you know, or go about operating their portfolio? So yeah, man, I mean, this concept is the concept. This is what it's ultimately all about. If you master this concept, you really don't even have to look at like the charts, right? In theory, you can just go against retail. And again, that's not financial advice, but that really has served me, fairly well. In something, for example, like Bitcoin. Retail believes Bitcoin is dead or a scam or too volatile as it, goes down aggressively as it experiences a retracement lower, ultimately just offering that asset at discount prices, literally being on the opposite of what retail is thinking, right? Retail thinks the asset is a scam. I want to participate, right? Because it's not a scam, right? There's like more to the surface level narrative going on there. Something like this AI bubble, in my opinion, it's a bubble. That is the talk of the town on, Twitter and financial news. That is the next big thing is AI. And I would agree it is, right? But to me, that is the opposite dynamic, right? Seeing everybody very, very interested, very emotionally, just ready to pounce on any opportunity that they can get their hands on with AI in the stock market. Personally, I am very cautious and really just kind of, in a state of observation with that whole dynamic, right? That whole phenomenon. Dude, I'm not saying there's not, opportunity there. I'm not saying it's all like, uh, like altcoins, if you will. Um, but plain and simple, it's just kind of like not my expertise. It's not part of my focus. It's just really not part of my bandwidth. Um, However, how many people, just kind of as a thought experiment, how many people have hopped on the AI bandwagon simply because they saw like this big herd of people going over to the AI bandwagon, right? So yeah, man, really interesting kind of conversation here on the market efficiency paradigm. That's pretty much all I got. Um, Feel free to email me down there. And yeah, thanks for watching. Peace.